to week 16. Hope all of you are doing well. Those are that are at least in. Obviously, being kind of Easter week kind of coming up, there's quite a few things that are going to be obviously on from a holiday, family, vacation kind of standpoint. As always, everything that is covered here solely views opinions. He's not trading, no investment kind of recommendations, no should be construed as such. We are taking a quick look at last week. A lot of moving parts. These are at least the things that kind of stood out to me. We continue to press up on equities. We spent a lot of time on that last week, and what I was basically trying to illustrate was if you look at these year-to-date numbers and you annualize them, I mean, we're talking for a lot of the main indices easily over 50% of the year, in some cases 70-80%. When you start looking at some of the Chinese equity indice names, I mean, you're talking about plus kind of 100%. So for instance, the Shenzhen in, excuse me guys, please, right? For instance, if you're looking at, let's say, the Shenzhen equity index, in US dollar terms, is up something like 44% year to date. So that's annualizing, easily over 150%. The point I'm trying to make here is the magnitude and the pace of the move up is possible, of course. Anything is possible in this market, but the actual delta and probability of it is not high. The other point that, again, we've been illustrating all year is volatility continues to get lower and lower and lower. So on the equity side, buying downside protection, or even if you expect earnings and equities to be up higher by the end of the year, which I do still believe that we will see higher earnings and lower yields by the end of the year, so I'm very much in the new highs kind of camp. That it's very easy and cheap, at least from a historical kind of vol perspective, to either hedge yourself or to play kind of for upside. So you kind of have the best of both worlds there. I would say it'd be imprudent, at least in my book, at least if you have a very long only bias or some kind of net long bias and don't have kind of some kind of hedges in place. So just food for thought. There, that trend continues. We did get the second continued uplift in yields. We now have bunds back up above zero. JJB still in negative territory. I'd expect those to get closer to zero, which we're already kind of moving. We're about 3.6 this Monday morning in Asia. US 10s are back over 250. Flirting with the 260 level, if you recall. I think we even had a 2.3 handle or something like 2.37. And again, it was just astonishing given the Fed rate is at 2.5. And we got US bonds, 30 years, basically flirting with 3%. I still think Aussie 10s at these kind of 188 are a steal. I would expect the RBA more than likely to kind of move towards a cut in May, but we'll touch a little bit on that, obviously, as we have some key data for Australia kind of coming up this week. Other thing I'll just point out, China econ, basically we're seeing big uplift in new loans that came in, beating expectations. What this is illustrating is a lot of kind of the stimulus and loose monetary policy in China continues to basically play out. Even I am finally starting to get a bit fatigued with Brexit, which is maybe a sign that we're closer towards the end. I'm not even going to ask any on here who happen to have some kind of UK lineages or ties or anything like that. But we basically got an extension of 6 months. I think while potentially this is near-term negative, we have seen a pullback in sterling. We have cable kind of now with a 130 handle, and if you recall, we got as high as 133 not too kind of long ago. But I think any kind of increase, again, in time, as we've said over and over and over, just pushes the probability more towards them actually staying, and basically it's basically construed as the pain of leaving, right? So I think that just increases. What now obviously changes, I would have preferred a much, much shorter extension, because over 6 months it's going to be very hard to kind of gauge what is that kind of catalyst that, kind of takes us out, and when is that going to happen? Are we going to get the same play out, around kind of Halloween and so on and so forth. So bit of a shame there, but it kind of is what it is, and obviously an extension is not going to magically change anything given the bickering that we've seen. So quite surprising, at least to me, also given the fact that we have these elections in Europe and the Eurozone. But in many ways, that maybe also ties them to staying. And actually, maybe that's an angle I didn't think about before. Again, key to watch there. I'll be monitoring to see if there's some kind of catalyst to kind of watch out for, but for now it's 6 months. It's a lot less exciting than it was. Structurally, I am still very, very constructive on being long kind of sterling and sterling kind of assets, but that's a big multi-year, if not multi kind of decade kind of view. That's unchanged. We covered that in last week's kind of Macro Monday with some of those quarterly long-term charts on sterling, but I think in the near term it's just hard to gauge. And of course, economic-wise, we're now going, what is it, plus 3 years, right, of just fatigue from business owners, from investors, so on and so forth, right? It looks like on the trade talks that have been going on that basically the last sticking points, which is basically seem to be an enforcement issue, mechanisms on both sides, is nearly a done deal, at least according to headlines coming out of Mnuchin. So would be interesting to see whether we finally get a Z-Trump summit announced. Obviously, nothing's going to happen kind of around this Easter weekend coming up, but maybe back end of April or early May could be interesting to see whether we're going to have the classic kind of buy the rumor, sell the fact scenario, or whether it's going to be a different kind of play. Obviously, now the focus on equities will be turning more towards kind of the earnings coming out of the U.S. So again, on the equities, I would just say look at the annualized FI we already covered. On the FX side, we'll look at the dollar index and the broader dollar index chart. Even though we had pretty big moves in a week of the US dollar last week, especially versus kind of some of the EMFX names, which I believe are breaking down to new moves versus the US dollar, i.e. strengthening to kind of the next kind of big wave down. From a DXY and broader dollar index perspective, we're still in similar kind of ranges. I still have the view of a structural lower dollar for the year, basically kind of across the board, but that doesn't mean you want to be short the US dollar versus anything. I still think it makes sense to be long. I have a structural long US bias versus the likes of, let's say, the Aussie or the Swiss franc, for instance, from a carry perspective, as well as also a divergence kind of play perspective. Commodities mix, not really much to say, and vol we kind of already kind of covered, continues to be dampened quite heavily. Ola is out for Easter break, so I believe the CART review will probably be out later on today by whoever is holding the fort out there. Upcoming week, big focus out here in the Asia Pacific. We will have RBA minutes out tomorrow, Aussie jobs data as well. We'll also have quarterly CPI coming out of New Zealand, always important. Most importantly, probably and watched by obviously the whole world, is going to be China first quarter GDP. 6.3 is what's expected. I believe there was also talks last week of Goldman upgrading their GDP expectation out of China, which is definitely bucking kind of the trend. So that'll be interesting to see how that kind of comes out. We will also have, of course, Easter weekend, so there's actually less people in already this week, and that could potentially also extend into kind of early next week, given the Good Friday. A lot of markets will be kind of closed around that time. From a central bank perspective, at least major-wise, we'll have Bank of Korea, Hong Kong. No key views on my side here. Of course, on Hong Kong, speculation comes on and off in regards to kind of the peg and where that is. So that's always taken a lot more kind of attention than it usually would be the case. There's quite a few Fed speakers also really on the radar. But again, maybe less pressure in regards to what they will say, given that we are seeing some bits of kind of green shoots from different parts of the world. U.S. Beige Book, again, always very good to see how the economy as a whole is doing, personal spending, housing data, and probably in Eurozone, ZW would be key. Now, on just Oz, if you remember last month, I believe it was, we had a kind of the big play on jobs data coming through from, so it was February, and what we had seen was basically for the last 2 years we'd had a big miss in Feb Oz jobs data, and we had that again this year. We are now kind of getting up towards the next round, and it'll be interesting to see how this kind of goes. If we have a big beat, I would expect obviously the likes of Aussie Kiwi to continue squeezing up higher, and the likes of also Aussie getting above kind of 72 kind of cents. I would still interpret these more as kind of tactical, kind of near term. I still think the the structural bigger term move is kind of to the downside. So it doesn't mean I'd like to get in the way, but just kind of food for thought. So 15K is what's going to be expected on the 18th. For Oz jobs data, unemployment rates at 5, and participation at 65.6. Just last time we got very abysmal numbers, 4.6 versus 4.9. What was astonishing last time was, at least to me, we traded up on the actual kind of numbers that came out, which probably told you maybe people were a little bit too kind of short the Aussie kind of coming into it, but it was one of those kind of few spectacular opportunities that the market kind of offers, because we traded up to about, I think it was 71.60, then proceeded to basically just kind of go down over kind of the next few sessions to even a few kind of weeks. Now maybe we'll see a bit of a reverse of that. The other key thing I'd like to say really on the RBA and Aussie crosses and Aussie Kiwi in particular is it's really kind of coming down to May. We will have not just the RBA meeting on May, I'm just pulling out here the calendar, 7th, but I believe also that Friday we should be getting their next quarterly update, where I would expect them to have basically downgrades both on growth and also on kind of inflation. So I think that's something for maybe people to kind of put in the calendar in regards to kind of playing it. From my perspective, it would be a bearish skew based on kind of everything we kind of know now. It's worth bearing in mind that, again, the jobs front is really kind of the last leg that has been holding up the Australian economy. And again, whether it's best to play through a bias on Aussie or a bias on Aussie rates or even equities is a whole different kind of thing. What's astonishing to me is, 27, 28 years with no recession, an RBA that potentially changed their statement to open for a dovish move, and equities in Oz are again close to all-time highs. Really, something to see in this kind of world and day. So going on, again, earnings very much on the agenda. These are maybe top 30 kind of companies that at least I know our equity folks watch. I believe JP Morgan reported last week something, the headline in the FT was something like the biggest kind of quarterly profit of any kind of bank in modern times, at least, or from all times. So obviously Goldman and Citi will be heavily watched later on kind of today. These are kind of a combination of US and Chinese names. This is kind of the days they'll be coming out. It's all obviously first quarter, and this kind of gives you a bit of a scope on market cap kind of perspective. I was actually looking for Boeing. Can't see that here. That could be definitely one to watch, as it just seems like even though we may not be seeing further kind of price downward reactions. They're reporting on the 24th, so that looks like that's going to be next week, but I'd expect quite a bit of provisions, i.e. from a perspective of canceled orders, i.e. from a perspective of lawsuits, and i.e. from a perspective of how quickly they actually get back clearance from the software issue they'll have. So it's really a question of, how much is kind of priced in. So worth just kind of paying attention to. This here is a little bit more for those focused on kind of China names as well. Quite a few big players also set out to kind of report and drive things. And folks always asking kind of about earnings kind of expectations. So these are the current earning estimates for the S&P 500, $41, about 7% year on year, at least from kind of a quarterly basis. And next 12-month PE estimates are about 17 times, and if you had to take next year's, then it's actually 15 kind of 0.7. So that gives you a little bit kind of context of where we are in regards to earnings expectations, and also where we are in regards to kind of implied valuations, right? And the other part here I'd just keep an eye on is this kind of div yield, right, of 2.1, 2.13%, because at one point, if bond yields fall kind of below this, then we could see what we started to see in Europe in kind of 2016 when we had, bunds at kind of minus 15, minus 20 basis points at one point, and the argument was obviously, why would you buy bonds when you can pick up equities, get a lot more kind of yield, and also have kind of potential kind of upside. Not trying to say that is a celestial argument, but it's definitely, I think, one that we'll kind of come back to see at some point. Going on just a few charts. This here is just giving you the last week as this first row. Last 2 weeks is here. It's all against the US dollar. This is G10s. This here is EMFX. You can definitely see we have quite a bit of a trend in regards to kind of a weaker dollar. So these are all on this side, at least outperformances against the US dollar. So total returns 1.69, for instance, for the NOK versus the USD. And over the 2 weeks, we've actually had the USD outperform versus the yen. And you can also see ditto kind of on the EM kind of FX side. It's really only the likes of TRY, the Swiss franc, and the yen that have kind of been losing ground against the US dollar. And interestingly enough, at least to me, the Kiwi. And this is no doubt still the aftermath and effects of RBNZ, which I still think is wrong from the market's perspective, because I think that move was more about the rest of the world rather than necessarily New Zealand kind of fundamentals. This here is just the VIX weekly chart, just to give you kind of context of where we are. It's been pretty much one big smooth ride down post the fourth quarter kind of sell-off. As you can see, we're below 200, we're below 100 weekly, we're below the 20-day weekly, and it looks like we're going to try and gun for the 10 handle again, which would start putting us in levels not seen since basically end of 2017, early kind of 2018. For you vol ladies and gentlemen out there, definitely something to kind of keep abreast of. Again, always the tricky part we go in long volatility is if you don't have a catalyst, it's obviously a time issue. So keep that in kind of context in regards to kind of how you're looking to kind of structure things and express a long kind of vol view. And obviously, speaking of volatility, this here is a 6-month at the money vol in the likes of cable. And you can kind of see just the massive kind of degradation that we had last week once we got that news of that kind of extension basically kind of going forward. And you can imagine it should even be lower on kind of shorter kind of maturities than kind of 6 months. So interesting to also kind of note that. This here is just kind of the same curve with basically the cable kind of price plotted kind of onto it, just to give a little bit kind of context to it. This here is, again, just weekly. We'll just look at a cable and a euro sterling chart. Again, I still think this is multi-generational. You can kind of see where we are here. Not too conclusive on the MACD or RSI, but this is kind of basically key support should be these kind of 129-ish, 130-ish kind of figure on that. This here is euro sterling. Obviously, euro been benefiting quite a bit. We're actually above a 113 kind of handle, at least kind of early on this morning. And just a few charts on Boeing. This came with quite a few kind of client discussions kind of the last week out here in Singapore and some in-house events that we actually had. This obviously is the big kind of break when China started to ground them, right? And I believe we sold off kind of 10% that day. You can already see it seems like we've bottomed out, at least from a chart perspective. And I think there's decent arguments on both sides, i.e. more pain to come, or i.e. Things kind of fairly priced in. This here is kind of showing what was maybe an obvious trade back then, which was basically just shorting the Dow Jones, because Boeing's such a big kind of component of the Dow Jones. And for those of you that don't know, that it's Dow Jones is kind of run on a price kind of metric, and Boeing actually has the biggest kind of contribution. And this would have been just basically short, let's say, the Dow Jones versus long the S&P or long the NASDAQ, so to speak. So this is Boeing in kind of green. You can see that underperformance that's recently kind of come into place. This here is, again, spread between the S&P and the Dow Jones. Doesn't look like too much here at about 100. Looks a little bit more interesting here against, let's say, the NASDAQ kind of 100, right? And again, the argument here is this maybe something that you watch for mean kind of reversion, or is this maybe a continuation play that you expect kind of the gap to kind of widen up? Last spread is really Boeing versus Airbus. Now, as far as I know, and again, I'm not an equity specialist. I rarely get the time or the bandwidth to do kind of deep dives on individual names, but this kind of was always kind of classic. I mean, Boeing was always, seemed to be the better kind of managed, the better kind of execution, so to speak. But obviously now you're seeing this interesting period of where Airbus is naturally outperforming versus kind of a relative perspective of what's kind of going on in Boeing, right? So food for thought there. One other thing, a few other things just before we kind of wrap up. So this was flagged to me by a client and a friend on coffee, and it was basically, are we bottoming out? Actually, when he flagged it, we seemed like we were trying to make kind of a move up, and then we had a massive reversal. I believe it was Thursday last week, down kind of 5%, making kind of new lows. MACD is still kind of bearish. RSI is inconclusive. The reason I'm flagging this is just to keep on the radar, and if you note the move that we had in September, October last year was massive, up kind of 36%. I have zero overview on supply demand fundamentals really in coffee. You may also kind of want to look at that, but the idea here is just to keep an eye and flag interesting kind of charts and kind of price action out there. So this is what I'm talking about. Even though we've had basically 2 weeks lower of DXY as kind of a whole, it is still very much in kind of the same kind of ranges that we've had. Yes, MACD is crossing lower. Yes, RSI is trending lower, suggesting that we may be going to test these kind of 96.60 levels. The big ones continue to be, this 200-week. Actually, this here is 200-day moving average of this kind of 96 handle and kind of a conclusive kind of close. And to be honest, if you just take a quick look at this chart, it just still looks like it continues to kind of trend potentially up, but we've just never really managed to conclusively close above kind of 97. So still range bound, but this is what's more interesting to me. Does not look as constructive. This is the broader US dollar index, so higher component of MXN, lower components of the yen and the euro, so to speak. Again, MACD trending lower, RSI a little bit more kind of inconclusive, but much closer to, you could say, this pivotal kind of 1191 92 kind of level. And the last two are going to be Aussie and Aussie Kiwi kind of slides. Again, big kind of move up last week. On kind of dollar weakness, I would say predominantly a big jobs beat could take us, I think, above 72 cents quite easily. Obviously, that's a big level because that's kind of the 200 kind of day. And, we've had this fantastic squeeze on Aussie Kiwi. This is RBNZ, basically, taking kind of people by surprise. A lot of this was kind of positioning. I was actually quite surprised with the continuation. I was expecting us to kind of come back, but we've continued to have this Kiwi liquidation, which I think is maybe the market just kind of overreacting, given that my view is RBNZ pivoted towards the dovish side to talk the currency down, not because they're worried actually about domestic fundamentals, which I still think are better than Australia, but just because they don't want the currency to get bid up too much. But the trend is still what the trend is. We have tried to punch up higher. We were above 106 early on this morning. We are, just kind of still there, 105, kind of 90. And if I was short here, I would definitely be making a stop kind of above kind of the 200. We seem to potentially maybe be getting tired here on the MACD. RSI still has not kind of crossed down, but of course with the Aussie jobs kind of data coming through and RBA minutes tomorrow, especially the jobs data, could basically much push it one way or another. With that said, let us come to the end of today's kind of session. Let me wish everyone a fantastic week up ahead. Do note we will have one last Macro Monday next Monday, and then after that we will skip one and won't be back until May 6th. Wishing everyone a very profitable, healthy, productive, and fun-filled week up ahead. All the best.